So far, what I've observed from the market, from trading for about 4 years now, and having essentially with no positive results, is that there's an ebb and a flow. That's why in and I'm just thinking out loud here. It's essentially what's happening is that the vast majority of the cases is there is a seesaw action. There's a sawtooth action that occurs. Generally speaking, for individuals like myself, when the market is going up, generally speaking, I tend to make money from the market. And that's where the account starts to increase. But in order for the negative sum, it's not a zero sum, it's negative sum. The reason why it's negative sum is that one exchange, essentially a disappearing sand, shifting of the sands. It's a disappearing shifting of the sand, where part of the sand disappears and the sand shifts from one pocket to the other pocket. That is the Wall Street market. What happens is Wall Street is an industry that is that taxes transactions. Transactions that causes commissions and slippages are the two factors that causes the negative part of the trading industry, where it's being sapped out, where it has been, where it's been being leaked out. The second part is whatever remains in whole is exchanged from one account to the other account, and it's a constant shifting. So the idea is to figure out on either I figure out to reverse the cycle of the point of when the shifting occurs to stop trading, which are two things: either not trade during that time or reverse it so that my strategy fits with that idea. So I have to draw this out. So far, my trading has been the trading results have been essentially, again, a negative sum kind of a situation where the sand that was in my pocket are being emptied to another pocket, with part of it uh, being commissioned and leaked into the Wall Street. And uh, so if I were to draw the results that I have, essentially is this. Okay, so the result is essentially like this on good days, and then on bad days it would be this. But it is actually a lower low. Goes up, and then lower low, goes up, and lower low. Just like the market, just like that. Whatever I entered into freshly deposited, it becomes this. That's inevitably the result of how my results in trading. So if I were to look at this situation and analyze what makes it this way, the primary factor, the primary mechanism is that essentially, if I look at this section A here, this is section B. And section C. And things like that. Okay, so, all right, maybe I can draw a little better. Label it. So that'll be A right there. So that'll be B. C. D. E. F. G. H. I. So this has been, it's a sawtooth kind of a situation, but it's in a perpetual downtrend. That is essentially that's what happens. So what happens from point A to point from section A, which is point from this point to this point, is there's an additive factor in here, which essentially is right here. Okay, if I look at the situation and to describe it, it would be adding to account and market going up. Okay, that's what happens here. If I were to describe what happens in section A right there. So if I look at A here, that's what happens. B essentially is market is down and account is depleted. That's what happens. And this is a repeated cycle here, which is it repeats here, 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 here. Okay. So for B, this market is down and account is depleted. Generally, that's how it works for people like myself here. That's what happens. So the idea then, how do I flip this around? How do I flip this around? How do I flip this around so that when I look at this, so when I look at this, so if I were to draw vertical line, So I draw this vertical line here. So then the idea is to start from here, goes up, right? Then invert it. So it goes up, and then invert it. It goes up, invert it, so it goes up, just like that. That's the idea. Just like that. So that means, simply speaking, this, I want to be in heavy here. So section A, what I want to be doing is section A, heavy in risk, and use the normal way of trading, which essentially is essentially, even if I buy a dip, which works, so buying a dip works really well. That's how it works. And scaling in. Okay? That's how it works. But when it gets into section B, I wonder if there's a way to pause this. Now, that is the case where generally speaking, market behaves just like that. The other way of considering this is looking at it from a perspective of if I look here, so the other way of looking at it is what happens is if I don't trade those times when the market is unfavorable, then it happens like this. It goes up, flat line. Okay? Then it goes up, flat line. Then it goes up, flat line. Goes up, flat line. Goes up, flat line. So this is still a positive return here. So this is a situation where I'd be trading during favorable market condition and not trading during unfavorable market conditions. Okay? With positive results. with positive results here. This is neutral. This one is trading during favorable market condition and trading unfavorable market conditions with adjustment. Okay, so that's what I need to figure out how to trade. Okay, this is the section that needs to be clearly. So if I look here, that needs to be clearly demonstrated here. Okay. So why don't we go ahead, move it up here. Why don't I just cut that right there. So that's the situation here. Positive, positive. This one is essentially positive and negative. So the scenario here is essentially trading during an unfavorable situation. That's it. Ideally speaking, I need to be trading in this region here, right here. That's what I would do. But this is where it's at currently. I could also trade it this way if things are unfavorable, and that's how things work. So that's I can do it that way. Okay, that's how I can fix it. Now this section right here is going to be very interesting to describe here, collecting thoughts on trading scenarios. I'm gonna expand upon this in section 15. Specifics of micro trading. Okay.